Today, we will be discussing our second strategy for investing. It is called the growth investing. Growth investing focuses on finding investments that have strong potential for future earnings and can be considered as the next big thing. However, it is important to note that growth investing is not speculative investing, but rather an evaluation of a stock's current health and its potential for growth. One drawback of growth investing is the lack of dividends. Companies in growth mode often need capital to sustain their expansion, leaving little or no cash for dividend payments. Additionally, higher valuations come with faster earnings growth, which can be a higher risk proposition for most investors. While there is no definitive list of metrics for growth investing, there are a few factors to consider. Growth stocks tend to outperform during periods of falling interest rates as newer companies can borrow at lower costs to fuel innovation and expansion. However, it is important to recognize that growth stocks are often the first to be impacted during an economic downturn. During periods of high interest rates, growth stocks don't always perform as well as the cost of borrowing rises, and the market can contract if wages don't rise to meet the challenge of increasing prices. In addition to these factors, growth investors should carefully consider the management prowess of a business's executive team. Achieving growth is a difficult challenge, so a stellar leadership team is crucial. It is also important to evaluate the competition, as a company may experience stellar growth but have limited long-term prospects if its primary product can easily be replicated. Growth investing is best suited for investors looking for shorter investing horizons with greater potential than value companies. It is also ideal for investors who are not concerned with investment cash flow or dividends. However, it is important to note that growth investing is inherently riskier and generally thrives during specific economic conditions. According to a study from New York University's Stern School of Business, growth investing may underperform value investing over long time periods, but there are sub-periods where growth investing dominates. The challenge lies in determining when these sub-periods will occur. Finally, it is important to consider the pros and cons of growth investing. On the positive side, growth stocks aim for shorter-term capital appreciation, often leading to quicker profits compared to value stocks. Once growth companies begin to grow, they often experience sharp and significant stock price increases. Additionally, growth investing does not heavily rely on technical analysis, making it easier for investors to start. However, growth stocks can be more volatile, and their stock prices may suffer if the company is not experiencing growth. Depending on macroeconomic conditions, growth stocks may need to be held for the long term, as increasing interest rates can work against these companies. Furthermore, growth companies rely on capital for expansion, meaning investors should not expect dividends. Entry into growth stocks may also require a higher investment compared to other types of stocks, as growth companies often trade at high multiples of earnings. If you enjoyed this, please like and subscribe. In our next video, we'll consider momentum investing.